Good evening, good afternoon, wherever you are. Welcome back to A Bit of the Block. And thank you for making the time to be here today. On today's episode, we felt it would be useful, informative, if we took a moment to discuss what's been going on recently in the markets with the price increases. And if one were to just glance at some charts, doesn't even have to be crypto, could be equities. Uh, it appears like we may just be in the beginnings of the next bull market. However, it's important that before we pull that trigger and buy and ape into XYZ investment, and nothing that is communicated tonight is in any way, shape, or form investment advice. Always seek a professional. This is just my opinion for educational and entertainment purposes only. Regardless, it is good to have a grasp on why the market is doing what it is doing and consider where things may be headed. Now, depending on your own particular background, you may or may not have investing experience, and that simply meaning for taking your capital, deployed it into a particular asset with the expectation of some type of ROI. Others, maybe you have. However, personally, just for context, the first time I ever invested in an instrument like an equity, it was actually a gold miner in 2016, and in maybe it was 2015, but worst case 2016. And then 2017 was the first time I invested in crypto. I bought Litecoin, and I proceeded to also put money into some other projects that don't exist anymore. But these things happen. And so I stayed around and was very active throughout 2019, 2020, 2021, 2022, and now. And so I just would like to take a minute, assess where we are, why we are in the current state of the market, and share some of my own advice on considerations as we transition from a bear market to a bull market. So before we really kick things off in earnest, I want to give a shout out to Third Academy for hosting us in this beautiful space and give you all a moment. Go ahead, grab some water, make sure you're cozy, you got your weighted blanket, whatever it might be, before we dive in. So we'll take a brief little 15, 30 seconds, let y'all do that. We're going to get into it. All right, all right. So let's start at the start. Are we in fact in a bull market? Well, that depends on your definition. Uh, if you were to look at a chart and you simply see prices are up or green candles, that in and of itself is not indication of a bull market. What is a bull market or indication of that is a sustained trend of higher highs and higher lows. Now, also bear in mind that a higher high and a lower low is also contextual and based on time frame. Because, of course, we are not at all time highs, and we are certainly beyond any sort of all time lows, presumably. But if you look at the daily, the weekly, and the monthly, you can see, particularly the weekly and the monthly, you can see that we are trending in a higher high, higher low direction for the first time in quite some time, many, many months. Uh, there's also another statistic that is interesting to look at that is really only possible because of things like the distributed ledger. But if you look at on a platform like Glassnode and you check to see the average cost basis of holders across Bitcoin, you'll notice that a week or so ago, there was a shift where over, I believe it is over 80 or 86% of all Bitcoin holders are back in profit from their cost basis. And so all this means is that 8 to 9 out of 10 people who've ever bought Bitcoin are in profit over the lifetime of their investments into Bitcoin. These sort of statistics are another indication that we are in a bull market. Now, and of course, seeing candles on a daily time frame that are 5%, 10%, 15%, these things usually don't happen in a bear market multiple times in the span of several weeks. We can see that on a very short time frame as a temporary rally, a relief rally, or a dead cat bounce. There's different names for it. But what we have seen appears to be the genuine beginning of a new bull phase, bull cycle. That may last 3 months, 6 months. It may very well last about a year and a half to 2.5 years. So why is this taking place? There are a lot of different ways to assess and speculate on why prices move in either direction. But one of the most straightforward reasons for this, and not just in crypto, but every market, is liquidity. Liquidity is, in my opinion, if you were only to look at one indicator or barometer to gauge where markets are trending or headed, it would be liquidity. And the reason is, anytime you buy something or you sell something, that can be an NFT, that could be Bitcoin, Ethereum, SWI, Solana, that could be Tesla, Microsoft, it could be gold, oil, it does not matter. Anytime you buy, someone has to be willing to sell it to you. Anytime you sell, someone has to be willing to buy. And so as liquidity goes up, what it means is that there is more money available. There's more cash in the system for people to do things with. Now, let's take it back about a year and a half to remember where we're coming from and how the bear market set in. Now, these are cyclical patterns in market, but our most recent bear cycle. Prices peaked out late 2021, early 2022. And what really changed things at that point that drove prices lower, it was liquidity decreasing. But why did the liquidity decrease? It decreased because interest rates increased. And what this meant was two different things. One was that the cost of borrowing capital became more expensive, which means that businesses or capital allocators, anybody that borrows other people's money to go out and seek a return, their profit margins got tighter, got slimmer. It became more costly for them to go and get new money to go do things with. At the same time, what it meant was that there was now a greater incentive to seek out a risk-free return in the form of government-issued debt instruments like bonds or treasuries. And so as a result, this motivates or it changes the appetite for risk. Bull markets are signified by risk-on activity, meaning we are going to take on, we will assume greater risk in pursuit of these returns. And when the opposite happens, when they say, hey, it's risk off, we're going to reduce our exposure to risk, it generally means that anything farther out on the risk spectrum, the risk curve, will get sold off. starting with the most high risk assets and then working its way back to the least risky assets. That being things like government issued instruments, bonds, treasuries. And so that is really what started the sell off in late 2021, early 2022. And as interest rates continued to rise at the fastest rate that they have ever risen in history, I believe, at least United States history, this became exacerbated. Less risk, more incentive to do the safe thing, buy bonds, buy treasuries. This caused its own set of issues, but that's beyond the scope of this particular conversation. But suffice it to say, as interest rates continue to rise, appetite to hold things like crypto or tech stocks, so on and so forth, continued to decrease, which continued the sell-off. As more people sell, it changes the supply-demand balance. There's more supply, but there is less or diminishing demand, which is going to continue to drive the price down. Now, what changed? Again, liquidity. And so how did this change? Well, the Federal Reserve, at least in the United States, and you could say globally, we have incredible influence, the Federal Reserve does, which is not a government agency, an independent organization. They have given forward guidance, which basically means they have signaled through their press conferences, their FOMC meetings, so on and so forth. They've signaled that sooner than later, at some point, interest rate increases will begin to slow. And so this is a major sign to the markets because it means, hey, if interest rate increases, the pace of them slows down, or they stop raising interest rates altogether, that is a signal to us that the Fed, that the central banks are also pivoting their outlook and their strategy. And as that pivot comes, what it looks like typically, if you look back at the last several market cycles, is that once interest rates pause, there's usually a reduction in interest rates. And after a reduction in interest rates, depending on the state of things, and again, beyond the scope of this conversation, but suffice it to say, the US government is running at a ridiculous deficit, meaning that they owe more money than they generate. The revenue that the government collects is several $1 trillion less than their burn rate. And the only way that they can fix that, they have a couple options. They can cut entitlements, they can cut military budgets, they can do a few things, but it's very unlikely that they do those things because they are politically not palatable. And we are in an election cycle. And so what usually happens is that they wind up cutting interest rates, which makes it cheaper to borrow money, which again will increase liquidity because more people will borrow the money because it's not as expensive, which gives them more margin to find returns. But usually it culminates after the rate cuts and them just printing money. And so when they print money, that is like the most direct injection of capital that most people are familiar with. And so this forward guidance, combined with the fact that other jurisdictions around the globe have already begun to make some of these adjustments that lean in the direction of increased liquidity, markets have responded. They said, okay, seems about that time that number go up. So we're going to deploy capital. And as soon as you see a couple of good candle spikes or large buy orders come in, it's a signal to other people. Oh, okay, you see so-and-so was up 5% last week, 10% last week. I think we're going to go ahead and buy some, increase my position, my exposure. And then it creates this vicious, virtuous cycle, depending how you look at it, that then exacerbates this effect of prices going up. Now, with crypto specifically, that's the macro backdrop. That's why you're seeing prices go up across every market for the most part, not just crypto. But when you look at crypto specifically, this has been supercharged by rumors and speculations of the Bitcoin ETF. Now, that news, BlackRock's application and several other firms' application, that came out many, many months ago. But again, when you're in a bear market, bullish news doesn't do anything. When you're in a bull market, though, bullish news is gasoline on a fire. And that is one of the major catalysts. Separately, we had Solana Breakpoint. There are a lot of Solana maxis. And so you have all these things come together. They come out of a conference jazzed up, hearing some developments about what's going to happen to Solana and the efficiency of the network, so on and so forth. And then you have things like the Sam Bankman-Fried case reach a verdict. This gives some people some closure, makes it a little bit easier in some ways for the liquidation process to take place for entities like FTX. And again, then you just have other narratives begin to pile on. And the most fleeting of news can cause prices to run. And it's a feedback loop. So that's why it appears we're in a bull market. Now, in addition to that, the reason that I am pretty confident that this is the beginning of a bull market that will likely run into Q4 of 2025 and early Q1 of 2026 is because next year is also the Bitcoin halving and as an election. And both of those things typically are positive for prices in markets in terms of them going up. The Bitcoin halving is a supply shock event. Its impact is diminished as time goes on, but it is still substantial and is usually a center point for news. And so then, given everything that's going on, let's just say that they pause or they begin to cut interest rates next year, and then let's just say that they print money in 2025. All of these things lead and lend themselves to prices continuing to go up as a trend, higher highs, higher lows for the next 2 years. Now, things to be cognizant and aware of if you are going to look for your own returns in this bull market. Probably the single most important advice that I could bestow you with is understand that you need to know precisely what your plan is before you do anything. Don't do anything off of emotion. Don't do anything off of a hunch. Sit back and develop a cohesive thesis for why you're doing what you're doing and what you expect to happen. In this thesis, it is also important that you acknowledge ways to track or gauge if your thesis is playing out in the way that you thought it would. Let's just say going according to plan or expectations. Likewise, you need to do the same to know if things are going counter to your plans or expectations. And then you need to have a plan of action for how you're going to handle either situation. This looks like take profit points. This looks like cut losses points. All these things you really want to think about before things really heat up, because it is much harder to think clearly as new narratives emerge, as the new shiny object comes around that is gaining 30% a day, seemingly for weeks on end. You hear about people waking up, throwing $500 in an investment. Now they have 20,000, 50,000. You need to know what your plan is. If you want to jump on things like that as they come up, factor that into your plan. Have capital set aside to do so, right? But at the end of the day, you need to know a plan. And you need to know and develop a plan that is for you, not a plan that is for somebody else, because everybody has different situations and circumstances. And so you don't need to follow what somebody else is doing, what they're telling you on Twitter, what they're talking about on YouTube. Your plan needs to be precisely for you and your goals. Now, the other thing to keep in mind is that bull markets are not up only. Quite the contrary. It is a series of steps that when you step back and look at it on a higher time frame, looks like higher highs, higher lows. But prices will go up and go down every day. And so for that reason, it is wise to acknowledge that you are very unlikely to ever buy the top, or excuse me, the bottom, and sell the top. And so likewise, you'll probably never be fully satisfied with your entry point or your exit point or your allocation or your position in something. Just accept that. This is why your plan is important. So you know what you're planning on doing and how you will adjust if things change. And so, on that front, my biggest recommendation for how you actually tactically go about any sort of allocation is to dollar cost average. So, anything that may be a part of your thesis that you find interesting, invest in, instead of just waking up one day and you see that the price has jumped 20% and now you throw X amount of capital at that position, regularly and consistently scale into the position up to the size that you want to have. This can look like buying $5 a week of Bitcoin, $10 a day, $1,000 a month, whatever it is for your situation. Map that out for the asset that you want the exposure to and what percentage of your portfolio you want it to be. And as these assets fluctuate in their value, monitor this and take time to rebalance your portfolio according to what your goal was. And the other thing to bear in mind before I open it up for questions and dialogue, the bull market will end at some point. And then a bear market will start. And the vast majority of anything you will have put your capital in will lose, quite likely, 60, 70, 80, 90% of its value. This is almost a certainty. That being the case, ask yourself, how would you feel having sold your portfolio for X amount of profit return, even if you could have squeezed out another 10, 20, 30, 50%, maybe even 100% return from where you sold versus where you, quote unquote, could have sold, versus how it would feel to have your assets' values round trip themselves, not just back to where you bought in, but below where you bought in, to the point where you're underwater on your investment and are forced to either sell and lock in that loss or hold that loss and carry it for several years until the next bull market, where it is uncertain if the assets that you allocated to in particular will even recover half of their value. So take profits and take profits often. And be careful. Don't overinvest. And realize you don't need to make all the money that you wish to have for the rest of your life in one market cycle.
Sae'Von, that leads to an interesting question. That was a really good point. Interesting question. You started by saying 86% of the Bitcoin holders are in the black, and they have profits that they are holding. Now, if you had Bitcoin just 8 months ago, let's say, at $17,000, $18,000, $19,000, it's now up to almost double or over double that amount. So is there an itch of people who have sitting with that position to double the money in 8 months or a year to sell?
It's possible. It is quite possible. And this is why I acknowledge that bull markets are not up only. Oftentimes, there are psychological levels. These are round numbers. These are multiples of 100, so on and so forth. And so every investor is going to be unique in really what their approach is. However, particularly for Bitcoin, and you can do this with other assets too, but Bitcoin in particular, you can take a look as well at how long people have held their positions without selling or transferring them. And this also gives you an indication of the ratio of people who are long-term holders, i.e., they don't plan to sell for decades potentially, or at least several years, and their behavior has indicated as much, versus people who just bought, when it was 17 for the first time, and now it's doubled. They are the most likely group of people to sell when Bitcoin hits, their targets or the psychological levels, 40,000, 50,000, 60,000. And generally, if people have held for that long, a lot of them will wait until the previous all-time high was reached. Doubling their money is definitely a really good benchmark, but particularly when things pass the all-time high, that is often where people will begin to shave some off if they haven't already.
Well, in a bull market, I noticed recently that number of the bigger cryptos, more well-known, more serious cryptos, let's say, like Solana, Cardano, Ethereum, have all risen. Not quite as much as Bitcoin, but they've all risen. Even a couple of the meme coins, which are
Mhm,
just gambler's paradise,
mhm.
have risen as well. A couple have dropped, but most have risen. How does somebody go about making a decision where to put their money, or should they spread their money as a hedge against one getting stuck in one? But they all seem to move relatively in parallel, interestingly enough.
Great question, and a bit of leading the witness. You know the answer there, Mike. So this is risk management 101. Generally speaking, in your portfolio, you want to anchor it with the least risky options. Now, being in crypto is about as far out on the risk spectrum as you can be, but let's just look at crypto as its own thing, right? Bitcoin is the least risky, followed by Ethereum. And then you have the majors, the top tens, top 20s, those sometimes wild things pop up in those categories. Um, but you want to have the majority of your portfolio anchored in those more stable assets. The trade-off, given that there are more stable, is that there's less upside usually, they're less volatile. But because of that, you can have more confidence that they're going to be stable aspects of your portfolio to root them. Whereas because of the volatility of lesser known projects, altcoins, low cap, mid cap projects, you need a fraction of the exposure relative to your safer assets, and you can still see phenomenal returns because the assets move more easily when new capital is injected. So you're usually going to want to, let's just say in theory, you have Bitcoin, ETH, Chainlink, and and some meme coin. Between Bitcoin and Ethereum, that'd probably be, anywhere conservatively from 50 to 75% of the portfolio. And then something like Chainlink, maybe you make that, 2.5, 5%. If you're really bullish, like 10. Uh, and then between various other low cap, mid cap projects and the meme coins, you begin to allocate a 0.5%, quarter of a percent. Now, even if you want to be more atomic with it, some people feel strongly that you should never put more than, oh, I'm thinking about trading, but in a particular trade, let's say you're swing trading, you generally never want to risk any more than 1 to 3% of your capital on any particular trade. So you look at an investment the same way. But again, 1 to 3%, like keep this in mind, that 3% is if you have extreme conviction. So if your portfolio is, 40, 50, 60, 70% of a particular asset, you're demonstrating, a lot of confidence and anchoring your portfolio in that particular asset. But with things like Bitcoin in particular, I would definitely say that is a safer way to go, which is also part of why, for different reasons, the amount of liquidity there, how long it's been around, the fact it's never been hacked, so on and so forth, its current activity, its growing activity, hash rates, this, that, and the third. But that's also how people like BlackRock, Grayscale, Fidelity, so on and so forth, how they determine what assets they want to allow access to for their clientele base. Is often the main thing they're thinking about is liquidity and access, as well as the volatility of it.
Yeah. Also, it's amazing how fast things change. Like about 8 weeks ago, when bond prices, even short-term bond prices, were exceeding 5%, it seemed that money was likely flow into the bond market and people would hold those for an extended period of time. And just 8 weeks later, the stock market's going up, Bitcoin's exploding, some of the other altcoins are doing very well. Any comment on how quickly things can change?
Yeah, that's why you got to have a plan. Anything. So, for instance, right? I didn't speak as much about things that could go wrong and upset the trajectory of the bull market. Though I think it is highly unlikely, there's a non-zero chance that the Bitcoin ETF gets denied. If it gets denied, that price Bitcoin crashing. It's crashing hard. If it gets denied, it's going to be a spectacular crash if it gets denied. Wouldn't crash to all-time lows or anything. It could swiftly fall from 40,000 to 20 something. You know, um, so same thing. With like Solana. Let's say Solana has some substantial outage. You know, they're known for outages, or even more particularly, as much as people are excited about Solana, particularly people who had a lot of faith in it, you should be aware that FTX is liquidating something to the order of 100 million Solana a week, I think, or a month, something like that. Um, I think there are court. I'm pretty confident there are court proceedings that stipulate how
Mhm.
much they're allowed to sell on a regular basis. But like the fact that the price has gone up so much, there needs to be enough buy pressure to offset the sell pressure that is coming for Solana, and it just may well, support it. But these are things to be aware of. If you're going to throw capital at an investment, it is your responsibility, your sole responsibility, to be as informed as you can about what is happening with that asset and anticipate what would be good for it and what would be deleterious for it.
Yeah, that's a good answer. Good answer. And how does the stock market starting to take off fit into this? Because stock market traditionally has been less reward than the Bitcoin and the other coins on the upside, but it's certainly in recent years a lot less risky, and with reasonable returns, but not quite as much risk as the coins, the crypto.
Yes, it goes back to the liquidity. It's that simple. I mean, people can try to cut it, skin it a bunch of different ways, but it's as simple as that. Liquidity went up. So hard assets, investment assets, they benefit the most from liquidity injections. Uh, there's this thing called the Cantillon effect, which basically dictates that the closer somebody or something is to the source of new money or money creation, the more wealth that they will accrue. And so this is why people who owned homes before 2020 did so well financially, is because the injection of capital had to go somewhere. And if there's more money in the system, but the same number of assets or shares or Bitcoin or X widget to buy, well, a bunch of money just got introduced, which likely means that the demand went up because there is now more, people have greater ability to buy and bid on those assets, but the supply didn't increase to match it. So it forces the price up. And so we're seeing that play out. When liquidity comes in, these assets absorb it. And based on the risk curve, that is going to dictate how reflexive and volatile that response is.
One question just came in from YouTube. The question was, uh, in somebody has been advised, the questioner has been advised throughout their life, quality, 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 mostly investing in the stock market. And
Mhm.
how can you tell quality in the crypto world? You can tell, you clearly can tell from some of the meme stocks, which are more gambling than anything else. But from looking at all of the coins that are now available, how do you tell? How do you follow that maxim of quality, quality, quality?
Great, great question. This goes back to a couple things. One of them is having a framework to creating your thesis. And part and parcel with that is DYOR, doing your own research and knowing what it is to look for. Somebody who is into stocks, they're going to be really interested in earnings calls and projections and inventory, supply chain logistics, the efficiencies, inefficiencies, management changes, competitors entering the market, moats around the business, any particular innovations, first mover advantages, uh, so on and so forth, regulatory changes that are good or bad for the business. They are going to study it and study it with rigor. Most people don't do that in crypto. And the ironic thing is oftentimes the things that have the best fundamentals don't perform the best. Things that have the best narratives and the most hype usually perform the best. That's why meme coins do so well. Simply because people are paying attention to it. They see the number going up. They want to also be a part of the number go up, so they put money into it. And then someone else sees it and they do the same thing, and the same thing, and the same thing, and then push the prices up until it collapses. Whereas an asset like Chainlink, for a very long time, was relatively, you could argue, undervalued. But why was it undervalued? Was it undervalued, or was there something about the emission schedule of the Chainlink Foundation and them selling Link to fund their operations that was offsetting the supply demand curve to such an extent that it suppressed the price? When someone is investing in Bitcoin, are they buying Bitcoin because of the narrative that it is digital gold? Are they buying it because they want a bearer asset that they can transport with them discreetly anywhere in the world? Are they buying it because it is a proxy to the value of the strongest computing network on earth? It depends on their thesis and how much research they've done and how much they know about these nuances. And so, if one is really trying to assess what quality looks like, they really need to step back and have a broader framework of what quality looks like outside of that particular asset. So, for instance, we don't have to reinvent the wheel. Management and quality management is always important. And so, when you're looking in crypto, you should know who runs that project, who is the team, what accomplishments do they have from the past? Where are they going? What's their roadmap look like? What adoption do they have? Are they necessary or are they a nice to have? Right? What sort of clients are? What sort of potential clients could they have that may demonstrate a need for what they're building? Uh, Literally getting as specific as what do the tokenomics look like for that particular asset, because that can have a major impact. Um, Understanding the differentiation on the technical level, right? A lot of people may not know this. I work at Miston Labs, the primary contributor to the Sweet blockchain. And of course, I have a much deeper and more robust understanding of it because I work there. However, there are a ton of nuances about the technology that make it far superior to a Solana, an Ethereum, many of these other chains. But a lot of people are undereducated on it, so they have no idea. So they may not be very interested in investing in it from a speculative standpoint because they don't know, right? Um, so all of these things are factors, but it really boils back down to having a thesis and then being able to do your research.
Maybe we'll have one last question before we end this very interesting session. And by the way, you mentioned DYOR, do your own research. Third Academy had just finished today a 6-lesson course by Hackett, Trust Army. who focuses on this that really went into depth on how to do some research, figuring out whether a project was real, had prospects, or was kind of a scam. But leaving that aside, the question that's come in is about Bitcoin having the impact. What exactly does a Bitcoin having mean, and what likely impact is it likely to have on Bitcoin price?
So the halving is a predetermined codified reduction in the velocity of new Bitcoin issuance into the ecosystem, the network, the supply. So ever since Bitcoin was created, every roughly 3.5 to 4 years, the block subsidy, the block reward, which is what miners are given as an incentive to continue to secure the network. This is why people spin up miners, and you see Marathon Digital and so on and so forth running these massive installations to mine Bitcoin. It's so that they can get that block reward, because it is a direct payment of Bitcoin straight from the source of the code. And so every 4 years, that subsidy, that reward gets cut in half, which is why it's called the halving, because that reward is reduced by 50%. And it will do this forever until the last Bitcoin will never be issued, because it will continue to get reduced. Or, it's asymptote. It approaches zero, kind of infinitely. But so what that does, what it means is that, one, it is more difficult for a miner to earn Bitcoin, in the sense that when they earn it, they earn less, they earn half as much as they used to. So it takes twice as much effort to get the same amount of Bitcoin that they used to, which usually forces certain people out of the market, or forces them to scale up their operations if they want to continue to make the same amount of money. And from a supply demand standpoint, the supply, again, not the total supply, but the pace at which new supply enters the market gets reduced. So, assuming all things remaining equal, if the demand holds constant, or if demand increases, then Austrian economics dictate that the price should go up.
Yeah, I think I get it. Hopefully, the listener got it as well. I don't think there are any more questions. So, Sae'Von, just on behalf of Third Academy, I'd like to thank you for doing this series of talks. They've been very informative, and we look forward to, when you get enough time, coming back and doing more.
It's been a beautiful time. I appreciate everybody's hospitality and allowing me into this space and hosting me here. And I am humbled to be one of the many folks helping to educate folks on this really important topic and technology. And I look forward to seeing what else comes from Third Academy. Thank y'all so much.
Thank you.